You are listening to chartingwealth.com for Friday, the 29th of May, 2015. Here is where the total market, that's what IYY is. It is a total market index fund, an ETF, which stands for Exchange Traded Fund. It basically tracks the entire market. And here are the candles. We have a 2-day trend line drawn for the last 6 days. Each one of these candles is a 2-day candle. And we have a 2-day trend line right here, and it reflects the movement over the last 6 days. And you can see what has happened over the last 2 days right here in this little bitty candle. This shows a lot of push down by the bears and pushed up by the bulls. And yesterday it was a doji. Today it's not quite a doji. A doji, you can look that up, D-O-J-I. Again, it shows that there's a lot of push and pull, and there's just as much power in the pulling as there is in the pushing. That is in the bears trying to drive the market down, the bulls trying to drive the market up, and they've sort of broken even. What does that mean? It means a lot of indecision as to where things are going. Technically, where are things going in the total market? Well, this is the MACD. The blue line is actually the MACD, the moving average convergence divergence. The red line is the exponential moving average in 8-period one. And whenever the blue line crosses over the red going up, what do you see that happens in the candles? This is the price movements, what these green and red candles, as we call them, reflect. The things coming off of them are actually wicks. You can see green wicks here, red wicks here, a red wick down. Those are where the price has moved to, but has gotten pushed back. Green bodies mean, of course, that the price started at the bottom and moved up, actually moved all the way up to the top of the wick, but got pushed back down before that candle closed. Red bodies mean that it started at the top and got pushed down. In fact, went all the way down the wick and then closed when it got to the bottom of that red body. So, real quick little candlestick lesson. It always is important to pay attention to them because they give us a good feel for sentiments and price movements. I think it's the best way to look at it. So what do we see? Well, we see a lot of movements in the market starting on the 12th, actually back on the 8th, pushing the entire stock market up. It topped out on the 20th, and this is all in May, and then started some significant down movements between the 22nd and the 26th. And then, of course, at the end of Thursday, we see the 2-day candle showing us that, in fact, there's a lot of indecision. The market did not continue to move down. In fact, it closed down technically for the day, but when you actually look at where the market closed, it actually closed higher than the low 2 days prior. What does that mean? Well, that means that it's not continuing to pummel down. And I was talking about the MACD earlier when I got into explaining what it was. What I wanted to get into is the MACD crossed over back on the 14th, and it has continued to move up. It did converge, that means coming back together, but it's never crossed over going down. So we are technically still in an up move on the 2-day trend line. The derivative oscillator is still positive, although it has lost a lot of its energy. Now let's move back and look at the 4-hour chart, and what do we see? Well, we see that the 4-hour chart just does not want to go above the 2-day trend line, but not even below it. The 4-hour chart ended the day with a doji. Again, a lot of indecision even at the end of the day. You can see the 4-hour chart crossed over going down the morning of, at the close of the market. That's actually the morning of the 26th of May, and it has continued to move down. It has gotten a little bit closer over the last few days, but it's still in a down move. Now, do we go by the 4-hour chart or the bigger 2-day chart? 4-hour chart's a half-day chart, or 4 times that size, the 2-day chart. We go by the big chart. Big charts for big moves, big money. I've given this analogy over and over again. If you're talking about the amount of movement on a 2-day chart, you're talking about a much bigger wave. The markets move in waves of greed and fear is what I say. It goes up based upon greed. It goes down based upon fear. Those are waves like ocean waves. And a big ocean wave has a lot more power than a little bitty wave, correct? The bigger the wave, the more power. Even though you might have little waves that try to affect it, those little waves don't have the same kind of power that a big wave does. That's the reason that we pay attention to the 2-day chart more. Now let's go back. So that's where the total market ended on Thursday going into Friday. Now let's look at the SPY, the Standard & Poor 500. This is another exchange traded fund that tracks the S&P. Now when we look at the S&P, we can see that it is very closely paralleling what the total market is doing. A lot of times because the S&P is 500, when we get down to the Nasdaq 100, talking the numbers of stocks, the companies that they're looking at, many times the SPY will track closer to the total market, but we like to look at both and get a broad, and then we start breaking down into more specificity. The S&P is, again, technically in an up move, and you can see also the movement over the last 2 days on the S&P is totally within the down candle and totally within, that is on the 26th, and totally within the up candle on the 20th. So again, the market's sort of stagnating, moving sideways right now is the way I would call it. It is technically in an up move. The derivative oscillator is still positive, although losing steam on the S&P. Now let's go to the 4-hour chart and see what it tells us. Again, lots of indecision the entire day, both throughout the morning and the afternoon. Again, as we try to track this, the 4-hour chart is technically in a down move. The big chart's in an up move. We'll continue to monitor this. Derivative oscillator's losing a little bit of steam as far as going down. It's not going down to the same extent that it was. So we'll continue to watch what's going on. Technically, the S&P and the total market are in long-term up moves as far as the 2-day chart goes, short-term down moves, but you can see it's really a sideways action at this point. Need to pay attention to where it's going to break. Is it going to break up or down? We don't know that yet. We just know that the big chart is still in an up move. It's going to take more of a downstroke to pull the whole thing down. Now, let's go back to the 2-day chart. And let's look at the Qs. QQQ. What is that? That is the Nasdaq 100. This is, again, another ETF. What do we see on the Qs? Well, it crossed over going up back between the 14th and the 18th over that weekend of May, and it has continued to move up. Actually, the last 2 days was an up move on the Qs. We can draw ourselves an okay trend line, not really connecting a whole lot of things, but we're in an up move. Derivative oscillator gained steam today. The MACD actually diverged, means that the lines, the exponential moving average and the MACD itself got further apart, which means, as you can see from the green candle, there was an up move. Now let's break that down to the 4-hour chart and see what we see. And you can tell that the 4-hour chart actually opened high, about middle of the candle from the up move yesterday afternoon, moved down, then reopened again in the afternoon after 12, and you can see that again where the chart is, it actually crossed over going up this morning right here on the MACD. Not a lot of movement, but it is technically, the Qs is up on both the 4-hour and the 2-day chart. Derivative oscillator is negative, but we pay more attention to the MACD than anything, and it is positive. So the Qs is up on both charts. SPY, total market are down on the short chart, but still up on the big chart. Now, lastly, let's get away from our indexes, and we're going to go to the one commodity that we track, and that is gold. And gold, if you've been listening the last few days, has been trying its best to cross over, going down. It did yesterday, and it heightened that even more today. Gold has crossed over, going down. Technically, on the 4-hour chart, you can see where gold slid sideways. 2-day chart. You can see where gold slid sideways for many, many days. It actually reached its highest high back on the 8th of April, and it has continued to slide sideways since then and is still not below where it went way back on the 4th of May as it was sliding sideways. It is now technically crossed over going down on the 2-day chart, and of course those who've been following, you know that it crossed over way back on the 19th on the 4-hour chart. So that is where we stand on gold as it ended the day today and as we get into it when the markets open tomorrow morning. So that is what we've covered as far as our indexes go and as far as gold goes. Keep all those things in mind as you get ready to enter the markets tomorrow morning. We wish you the best. We'd love to hear from you. Again, chartingwealth.com. All you got to do is follow us on Twitter, Facebook. You can always go to chartingwealth.com and join us there. We love your comments, your questions, your concerns. Please make sure to pay attention to all of our different trainings. We're here to help, and we like to hear from you. God bless. Good trading, great investing.